All right, next we're going to tackle PQ5-5. So Tablet World Inc. had the following transactions during the month of November, 20XX. So on November 1st, you have the following opening balances. So we're just going to plug these in, simple as that. So for cash, it was 15,400. For inventory, it is 1,900. For accounts payable, it is 280. These beginning balances are simply the balances from the prior accounting period. This is simple as that. So don't get confused. Just add them in, simple as that. And even though retained earnings is given to us, the chart that's provided, it doesn't include retained earnings in there. So we're just going to ignore that altogether. Retained earnings has nothing to do with these transactions anyway, so don't get tripped up over that. Let's dive straight into the transactions. So these transactions are mixing some of the transactions from the past chapters with what we learned in this chapter so far. So it is mixing everything together. Like I said, don't get tripped up over that. This is what accounting is. So we're, like I said, it's like building a house, right? Now we have the foundation to do the prior questions as well and apply that foundation to the current chapter. So we purchased a 1-year insurance policy for cash, 1,800 plus 8% sales tax. So instead of having HST of 13%, they have an 8% sales tax. So to calculate that balance, once again, the formula is before tax amount times 1 plus the tax rate. So we already know that. So 1,800 times 1 plus 0.08 is going to give us our after-tax amount of 1,944. So simply put, we paid cash for this. So cash is going to go down by this amount. And then prepaid insurance is going to go up by this amount. Now, November 3rd, we purchased 8 tablets for inventory from Western Wholesale. Credit terms are 210 and 30. Shipping terms, FOB shipping points. Let's have a quick discussion on this. 210 and 30 means that if we pay within 10 days, we get a 2% discount. No matter what is due within 30 days. So if you don't pay within the 10 days, we get no discount. But the N stands for net is due within 30 days. Once again, if we pay within 10 days, we get a 2% discount. No matter what is due within net 30 days. FOB shipping points simply means that at the point where the seller ships it out, it exchanges legal title. So during transportation, it's in the buyer's possession, where the buyer, that means we pay for transportation or freight costs. Freight costs and transportation are used interchangeably. They mean the exact same thing. So let's go ahead and journalize this transaction. We're going to increase inventory by 2240. And by the same token, remember, whenever we have terms and we're the buyer, that means accounts payable. So we're going to increase our accounts payable by the exact same amount. Now, November 4th, the appropriate party pay for freight costs. We've already talked about this. Since we're the buyer, is FOB shipping point, we're going to pay for it. And we're paying for this with cash. So negative 140 cash. And remember, whenever we pay for transportation of the original purchase, that increases inventory directly. And as a reminder, if we return something and we pay for transportation, that constitutes as an expense. So now we purchase office supplies using a business credit card. This is a quick review. We already know this stuff. Office supplies goes up by 185 since it's a credit card. Accounts payable also goes up by 185. Now, November 7th, we returned 1 tablet purchased from Western Wholesale. It was defective and never worked. As a result, since it was their fault, they're like, we will pay for the return freight cost. So in this case, we have no transportation expenses or freight expenses, so we can ignore that altogether. Since we didn't pay for it, they paid for it. So in our books, it has nothing to do with us. So just ignore that altogether. However, that could be different for a different question. Remember, don't memorize it, understand the material. So since we returned one of the tablets, our inventory is going to go down by 280. And as a result, our future obligation, accounts payable, is also going to go down by 280 because we don't owe that money anymore since we returned it. Simple as that. Now on November 12th, we paid Western for the goods purchased. Hint, check if it was within the discount period before paying. Don't forget to take the return into account also. Remember over here, we set up 4 questions. Let's copy and paste these over here again, and we can apply these again. I'm just going to delete that. Okay. So the first question is, did we pay within the discount period? We got this on November 3rd. 10 days is the discount period. 10 plus 3 is November 13th. We paid it by November 12th. So yes, we did. Second question is, what is the total balance owing? So remember, 2240 is what we originally owed. But then remember, we returned 280's worth. The 185 has nothing to do with our inventory, so we ignore that. That's really directly to office supplies, not inventory. We're talking about inventory in the specific question, so do not get that confused. Remember, supplies and inventory are 2 different accounts. So minus 280. Now, what is the discount? The discount is the amount owing, 1960, times the 2%. 210. If we pay within 10 days, we get a 2% discount, 0.02, 39.20. And then the amount owing is 1960 minus the 39.20. Okay, so in reality, on November 12th, our cash is only going to go down by 1920.80. Because remember, we get a $39.20 discount. And our total accounts payable is going to go down by the total amount that we owe. So what is the total balance owing? That's going to reduce our accounts payable. The discount is going to reduce our inventory. And the amount owing, what we actually owe in cash, is going to reduce our cash. If that confuses you, pause, rewind, and redo it again, please. Now let's fast forward to November 18th. Now we purchased tablet accessories from Computer Wholesale. Credit terms 115 and 35. Shipping terms FOB destination. So once again, credit terms 115 means if we pay within 15 days, we get a 1% discount. No matter what, it's due within 35 days. FOB destination means that legal title exchanges hand once it arrives at the buyer's warehouse. We're the buyer. So during transportation, it's in the seller's possession. So that means that the seller pays for transportation. That means for us, we don't do anything. But let's deal with November 18th first. November 18th, we bought additional inventory for $1,500. And our obligation, accounts payable, also goes up by $1,500. Simple as that. So now November 19th, the appropriate party pays for freight costs. Like we said, since the seller pays for it, for us is no entry. So simply put, no entry. Simple as that. It doesn't impact our books because the seller's paying for it. It has nothing to do with our company. Simple as that. Now, on November 23rd, pay the outstanding balance on the business credit card for the purchase of office supplies, $185. Simple transaction. Cash is going to go down by $185, and our accounts payable is going to go down by $185. Sorry, $185. Next, paid Computer Wholesale for the purchase on November 18th. And check the discount period. So once again, let's apply these questions again. I'll put it over here, make it easier. Delete all this from the prior question. Okay. First question, did we pay within the discount period? So we bought this November 18th. discount period is 15 days. So 18 plus 15 is 33. So we pay within by November 28th. That's within the discount period, obviously. So we do get the discount. Yes, we did. What is total amount owing? So we didn't return anything, right? So total amount owing is just going to be the 1,500 from this transaction over here because we didn't return anything, right? So the return is going to be 0. Then to calculate the discount, we're going to take the 1,500 and we're going to times it by the 1% because it's 115. Remember, 1%. We're going to times it by 0.01. Then to calculate the cash that we're actually paying, we're going to take the 1,500 and subtract it by the discount, $15. So in reality, we're paying cash of only $14.85. So that's going to be reduced. Our inventory is going to be reduced by the discount. And now our accounts payable is going to be reduced by the 1,500, which we originally owed them. So 1,500 accounts payable reduction, $15 discount reduction on inventory, $14.85 reduction on cash of $14.85. Now for November 30th, determine the amount of supplies that were remaining at the end of the month. Hint. So what do you have to record? So originally we bought supplies of 185 and we have 65 remaining. So do it over here. So bought supplies of 185, remaining is 65. That means we must have used up the difference. Simple as that, right? So we're going to do 185 minus 65. So our office supplies, it's going to be reduced by 120. And as a result, our office supplies expense, or sorry, our supplies expense is going to go up by 120 because our expense, our cost of doing business is increasing. So now we recorded the use of insurance coverage for the month. Remember, 1,800 plus 8% sales tax was 1,944. This is for 12 months. To calculate the monthly insurance, we're going to take the 1,944 divided by 12 months. That's what we used up during the year. So our prepaid insurance is going to be reduced by this amount. And by the same token, insurance expense is going to go up by this amount because we've actually incurred or used up that expense. Now to calculate the totals, I'm going to just put in a quick formula, but you're going to simply do 15,400 plus negative 1944 plus negative 140 plus negative 1920.8 plus negative 185 plus negative 1485. Then I'm going to just run this formula all the way across. So you can do the exact same thing for all of them. Let's just say, for example, accounts payable. I could do it for you manually over here. 280 plus 2240 plus 185 plus negative 280 plus negative 1960 plus 1,500 plus negative 185 plus negative 1,500 gives us 280. So there you go. All right, so all the transactions are now completed. Let's just keep going down and tackle the actual questions at hand. So what is the per unit cost of the tablets you purchased from Western Wholesale? We purchased 8 tablets for 2,240. So that's the original cost, right? So 2,240, but you have to keep in mind now that the price that we paid of 140 also increased our inventory for those products. And remember, we returned $280 worth of products as well, right? Right over here. And then you have to keep in mind, we got a discount as well. We got a discount of 39.20. So we're going to subtract that as well. So once again, any transaction that has to impact the inventory for Western Wholesale is going to comprise of the final value of inventory. So the original invoice price plus transportation, because remember it's FOB shipping point. Subtract the return, subtract the discount that we got because we got the inventory for less because we paid before the discount period before the discount period. So the total value of inventory is 2060.8. And keep in mind, even though we bought 8 tablets, we returned 1. So to calculate the per unit, we're going to take the total cost and divide it by 7 units. Because remember, we returned 1. The per unit is 294.40. What do you think would be a good price to sell the tablet for given their per unit cost? So essentially, any price that's going to be above 294.40, right? Let's just say we're going to mark these up by 100%. So that means we're going to sell it for double, essentially, right? So that being said, so if we're selling for double, so let's just say we're going to mark it up by 100%. This is very similar to the tax calculation that we did. We're going to take this amount times by 1 plus the percentage. In this case, the markup instead of the tax rate. Since it's 100%, we're just going to do 1. Remember, if it was 90%, we do 0.90. If it was 120%, we'll do 1.2. So the cost is going to be 588.80. Now remember, revenue less cost of goods sold gives us gross margin or gross profit, right? Gross profit. So in this case, our revenues is 588.80. Our cost of goods sold is 294.4. That means our gross profit is going to be 294.4, correct? So to calculate the gross profit margin now, this is going to be a product of gross profit divided by revenues. So simply put, we're going to take the 294.4 gross profit divided by revenues, 588.80, to get the gross profit percentage of 50%. If this confuses you, don't worry about it. We will come back to this in a later video and redo it. Why is Tablet World required to make the 2 entries on November 30th? Your answer should reference the definition of the elements of asset and an expense. So, technically speaking, on November 30th, these 2 transactions that are taking place are considered to be year-end adjusting entries. So simply put, remember, the definition of an expense is cost is incurred, consumed, or used up in order to help us earn revenues. Supplies and assurance helps us earn revenues, and we have to record it in the same accounting period. It helps us earn those revenues, so we have to do a month-end adjusting entry. Remember, asset is a future benefit. If we use up supplies, the future benefit is decreasing. That's why we have to decrease assets. Or if we used up insurance, our future benefit is decreasing. So that's why we have to decrease our insurance, or once again, our assets. If Tablet World did not make the entries on November 30th, what qualitative characteristics would they violate? This is a good question. This will be faithful, because the financial statements will not be free of error. Simple as that.